There are moments in trading that obsess me so much that just looking back at the chart makes my heart tighten. Those are the times when the market moved too fast, shattered all my predictions, and left behind the helpless feeling of a trader who didn't understand what he should have known. Have you ever experienced those red candles stabbing straight down like a knife? A breakout that seemed real, but turned out to be a trap? Or those times you wondered why you always entered trades right at the most chaotic point, just before the market reversed? I used to be like that, tired, frustrated, even panicked every time I looked at a chart. And then one day I discovered something that nearly froze me. A harsh but simple truth. All my failures came from one single reason. I did not truly understand the structure of price movement itself. I know it sounds cliche, but when I realized I had ignored the most important foundation in trading, it felt like the whole world slapped me in the face. All the fancy indicators I clung to, the colorful buy-sell signals, the methods I spent time learning, they all hid a simple truth. Price only follows trends, and trends always leave footprints. That footprint is the trend line. That day, I decided to start over. I forced myself to look at the market in the most primitive way, just price and trend lines. No indicators, no complex systems, no tricky patterns. And that journey led me to the trendline method that Tori J., a very famous trader, used to build her success. And today I want to share with you the entire foundational perspective, the first part of the 3 trendline methods I learned from her. Before we begin, welcome to the Trader's Path channel. If you are someone looking for a clear, practical direction that you can apply immediately to your trading, then you are in the right place at the right time. Now we enter the important introduction, the foundation for you to understand the 3 trendline methods deeply and apply them sharply. I want you to imagine something first. A good trader does not chase every candle, does not panic at every market jerk, does not stare at charts all day hoping to see something happen. Instead, they do one simple thing. They look at the big picture first, then zoom in. And when they see what the crowd doesn't, meaning the trend structure from the higher timeframes, they already hold about 70% of the winning probability. Trend lines only become truly accurate when you understand how the market moves from higher to lower timeframes. You cannot draw a trend line on the 15-minute chart and expect it to reflect the movement of the entire day. That's like using the naked eye to look at a drop of water and trying to guess the color of the entire ocean. Impossible and unnecessary. So the first step of the trendline system, the most important step, is building the analysis structure from higher to lower timeframes. I always start from the monthly timeframe. The monthly chart is like the market's master map where all major trends begin. You can see peaks and troughs lasting for years, where the market formed the strongest reaction zones. They are points where big money acted. When I draw the main trend line on the monthly chart, I am marking the lifeline of the market. That is the backbone of the entire system. After finishing the monthly chart, I go down to the weekly time frame. This is where the trend becomes clearer, like stepping closer to a painting to observe details. On the weekly chart, I adjust the main trend line if needed and begin drawing secondary trend lines, smaller trend lines that follow more recent price movements. Each of these trend lines is like a smaller branch of a big river. They don't change the river's nature, but help you understand exactly where the flow is strong, weak, or about to turn. When I switch to the daily chart, I begin to see the subtle rhythms of the market, the small corrections, the compression candles, the highs and lows invisible from afar. And this is the time frame that made me say, wow, when I truly understood trend lines, because on the daily chart, everything becomes alive. The major trends from the monthly and weekly charts turn into real movements. You can practically feel the market breathing. When I go down to the 4-hour chart, I start focusing on each pulse of the market, but only when the higher time frames do not give enough signals. I always remember one principle: only go to lower time frames when necessary, not out of curiosity. Losing traders are those who jump between time frames without knowing what they are looking for. And the final time frame I use in this system is the 1-hour chart. This is where I stop because Tori J's method is swing trading. You don't need to go down to 15 minutes or 5 minutes. The smaller the time frame, the more noise, and that can destroy your calmness. The 1-hour chart is where the structure of minor trend lines becomes clearest, enough for you to find precise entry points. When all trend lines from higher to lower timeframes are drawn, I look at the chart like looking at a network. The main trend lines from the monthly chart are highways. The weekly trend lines are major roads. The daily, 4-hour, and 1-hour trend lines are the smaller lanes leading you exactly where you need to stand when the market is about to make a big move. And it is the intersection of these lines that creates the most important signal zones, the key that opens the 3 trendline methods I will share with you next. These 3 methods are all based on the trendline system I just described. The method when price touches a trend line and bounces, the method when price breaks a trend line, and the method when multiple trend lines intersect to form a confluence zone. If this foundation is not solid, these 3 methods will never bring real results. And I know if you're listening to this, it means you truly want a clear, logical, non-luck-based path you can apply immediately. So before I continue with the next parts, take a few seconds to subscribe to Trader's Path. You only need 1 click, but it gives me motivation to create more valuable content for your trading journey. The 3 trendline methods that every trader must know. It's time for me to put 3 keys in your hands. If you master them, you will see the market in a completely different way. You will no longer predict, you will no longer gamble, and you will no longer chase news or unpredictable spikes. You will simply read the language that price is writing right before your eyes. And to make it easier for you, I will divide this into 3 logical, clear methods. I want you to feel as if you are sitting next to me, and I'm telling you step by step, each touch of the line, each breath of the market. Method 1. Trading when price touches the trend line and bounces. I must be honest, this was the first trendline method that changed the way I observe the market. It is also the method that most good traders consider the gateway to reading price behavior. It is simple, but when you truly understand it, you will see how sharp and powerful it really is. Imagine you're looking at a clear downtrend, lower highs forming one after another, the market dropping like a runaway train. You draw a descending trend line connecting the highs. Then price starts moving up toward that trend line. This is the moment I want you to focus on because it is the heart of this method. When price touches the descending trend line, you must observe how the market reacts. A touch followed by a strong rejection downward is the clearest signal. The selling force is still there, the trend still dominates, and the market is telling you, do not go against me. Why is this touch so important? Because it is where buyers challenge sellers. Buyers try to break structure, but when they fail to break the trend line, they get pushed back, creating a rejection. And that rejection is the entry opportunity every professional trader looks for. I want you to remember, not every touch is an entry. Not every touch is reliable. Not every touch will cause the market to bounce the way you want. You need confirmation. A strong rejection candle, a pin bar, an engulfing candle, or simply a long bearish candle wiping out buyers' efforts. When you see that, you are seeing market psychology, not just lines. This is why this method is so strong. It is simple but extremely refined. The key is patience, waiting for the clean touch, the clear reaction. Your entry becomes perfect, your stop loss small, your potential reward large. And when price bounces from a descending trend line, the market often makes deep drops. If you stay disciplined, this may become one of the most effective trendline methods you ever learn. Method 2. When the market steps into a new realm. If the first method helps you follow the trend, this one helps you catch real reversals. And I must say, catching a clean, accurate reversal is a special feeling. It's like seeing a secret door others don't see, and you walk through it first. But this method is not for the impatient. You cannot simply see a trendline break and jump in. You must recognize whether the break is real or fake. Let me tell you a true experience. Once I saw a strong downtrend. The descending trend line had been respected for many days. Each high was lower than the previous. Everything showed sellers had absolute control. Then one day, price broke above the descending trend line with a strong bullish candle. I thought, this is it, the reversal. But I was wrong. The next candle reversed everything. Sellers weren't weak. They simply let buyers rise a little, then crushed them. From that moment, I learned the most important lesson of breakout trading. A break without a retest is not a real break. A break without structural confirmation, volume, or price behavior is just a trap. So when price breaks a trend line, you must wait for the retest. You must wait for confirmation. You must see that the market truly wants to step into a new realm. If after the breakout price retests the trend line, forms a higher low, and bounces strongly, this signals that the trend has changed. This method gives you entries aligned with the new trend. Moves that run far are easier to hold with beautiful reward to risk. But only if you wait long enough. Discipline is the key. Most traders lose with this method because they rush. Let me repeat a truth. A breakout is only real when the market proves it through behavior. Method 3. This is the upgraded, more precise method, requiring refined observation. When you draw multiple trend lines, higher timeframe trend lines and lower timeframe trend lines, you will notice that sometimes they meet at a point. That is not random. It is the intersection of market forces, where both buyers and sellers are forced to show their hand. I call it the crossroads of destiny because the market will never move sideways there. It must choose, either explode upward or break downward. No middle path. Why is this intersection important? Because it combines both long-term and short-term trends. Because it is where higher timeframe traders make decisions and where lower timeframe traders see opportunities. And because the market cannot pretend there. A bounce from this intersection is much stronger than a normal trendline bounce. A break from this intersection often triggers explosive moves. When you catch such a move, you feel like you're standing right where the market turns. You're not following the market, you are moving with it. The trading method is clear. Observe the trendline intersection, wait for the reaction. If it bounces, enter with the confirming trend. If it breaks, enter in the breakout direction. Stop loss goes just beyond the intersection, tight and safe. I once caught a long-term trade from exactly this kind of breakout. Price moved thousands of pips. I held for weeks. And that was when I understood that trend lines aren't just tools. They are maps of market psychology. These 3 methods aren't just techniques. They are 3 ways to listen to the market. Each trend line touch, each break, each intersection is a conversation the market is having with you. If you listen, you will understand. If you understand, you will act correctly. And most importantly, you won't be swept away by chaos. You have structure, a system, a clear direction. Now, when you've understood the 3 trendline methods, you might feel excited, ready to jump into the market and apply them. I understand that feeling. I used to be like you. Whenever I discovered a technique that helped me see the market clearly, I felt a surge of energy pushing me forward. But I want you to pause, breathe deeply, and listen carefully to what I'm about to say. This final part determines whether you keep your money, not whether you make money. In trading, sometimes keeping money is harder than making it. Without proper trade management and psychology, no matter how sharp your trendline methods are, you can still blow your account. So this final section is not just the end, it is the foundation for your survival. Rule 1, stop loss, the boundary protecting you. Many new traders see stop loss as their enemy. They think stop loss is where the market hunts them, takes their chance, makes them lose money. But the truth is the opposite. Stop loss is your best friend. It is the safety rope on the cliff's edge, the shield protecting your account when the market goes wild. And with trend lines, stop loss becomes clearer than ever. When trading at a trend line, either bounce or breakout, your stop loss must always be on the other side of the trend line. Not too far, not too close, just slightly beyond it. When price reaches that point, you know the story has changed. The trend is no longer what you thought. The market is writing a new chapter, and your job is to step out immediately. I've seen traders place stop loss too wide out of fear of being hunted, losing more than necessary. Others place it too tight and get knocked out by minor noise before price goes in their direction. What I want you to remember, stop loss is not for safety, it's to protect your analysis logic. When price breaks the trend line in the opposite direction, your idea is wrong, and exiting is the only right reaction. Losing traders are those who hope too much. Another interesting thing, most traders love technical analysis. They love drawing trend lines, finding entries, but they ignore one of the most important things. When to take profit. Price always moves in waves. Trends never go straight. So no matter how perfect your entry is, price will eventually retrace. Without a take profit plan, you may turn from winner to loser simply because you refuse to close the trade. With trend lines, you have two main take profit approaches. One, take profit at strong resistance zones, previous highs or lows, confluence with other trend lines, or areas with many past reactions. Wherever the market made major decisions before, it can do so again. 2. Use a trailing stop based on structure. This is my favorite. Instead of fixing a target, I follow price as it forms new highs or lows, adjusting my stop loss accordingly. This allows me to ride long swings of hundreds of pips without falling off. Many ask me, how many pips should I take profit? My answer is always, follow structure, not emotions. When trading trend lines, the market will tell you when to exit. You only need to listen. You will have trades where analysis is perfect, but price moves slowly, making you doubt yourself. Trades where you have big profits, but a small retracement scares you into closing early. Trades where you have a small loss, but refuse to accept it, turning it into a big loss. We all go through this. I have too. And you will feel these emotions hundreds of times more. But one thing helped me. I don't try to control price, I follow it. I don't argue with the market, I read it. I don't expect the market to behave as I predict, I react to what it shows. Trend lines are not magical, they are compasses. But if you place your emotions on the scale, even the best compass won't save you from losing direction. So let me remind you, trading is a journey of patience and discipline. You don't need to win every trade, you just need to survive long enough for your method to show its power. Multi-timeframe analysis is the backbone of trendline trading. If you look only at small timeframes like 5 or 15 minutes, you will get caught in noise. Price moves chaotically on small charts, making you draw random trend lines and receive false signals. I always start from monthly, weekly, daily, 4-hour, then 1 hour. The higher timeframes show the main trend. The lower timeframes show entries. This prevents me from being confused by short-term noise. Higher timeframe trend lines show where the market wants to go. Lower timeframe trend lines show where to enter. When they align, that is your best, safest, most powerful signal. If you've reached this final part, you are no longer just someone listening to a video or reading a guide. You have gone through all 3 layers of trend lines. You know how to read reactions, understand real and fake breakouts, sense the strength of trendline intersections. You know how to manage trades to survive, how to stay disciplined, and how to follow the market. I spent years learning these things. I lost money. I was confused, doubtful of myself. But I didn't give up. And I want you not to give up either. Because once you grasp these lessons, you have a solid foundation. You are no longer gambling. You are becoming a trader with reasoning, with a system, with a guiding light. And if what I shared helped you see more clearly, gave you a new perspective, or made you a bit more confident in your trading journey, then don't hesitate to take a few seconds to subscribe to Trader's Path. It gives me motivation to continue creating deeper, more practical, and more valuable videos for you. See you in the next parts of this journey.